Eastern Manufacturing is involved with several situations that possibly involve contingencies. Each is described below. Eastern's fiscal year ends December 31st, and the 2009 financial statements are issued on March 15, 2010. A. Eastern is involved in a lawsuit resulting from a dispute with a supplier. On February 3, 2010, judgment was rendered against Eastern in the amount of $107 million plus interest, a total of $122 million. Eastern plans to appeal the judgment and is unable to predict its outcome, though it is not expected to have a material adverse effect on the company. B. In November 2008, the state of Nevada filed suit against Eastern, seeking civil penalties and injunctive relief for violations of environmental laws regulating hazardous waste. On October 12, 2010, Eastern reached a settlement with state authorities. Based upon discussions with legal counsel, the company feels it is probable that $140 million will be required to cover the cost of violations. Eastern believes that the ultimate settlement of this claim will not have a material adverse effect on the company. C. Eastern is the plaintiff in a $200 million lawsuit filed against United Steel for damages due to lost profits from rejected contracts and for unpaid receivables. The case is in final appeal, and legal counsel advises that it is probable that Eastern will prevail and be awarded $100 million. D. At March 15, 2010, the Environmental Protection Agency is in the process of investigating possible soil contamination at various locations of several companies, including Eastern. The EPA has not yet proposed a penalty assessment. Management feels an assessment is reasonably possible, and if an assessment is made, an unfavorable settlement of up to $33 million is reasonably possible. And the requirement on all of these is that for each of these four situations, prepare any necessary journal entries and indicate whether a disclosure note is required. Okay, for Case A, Eastern was involved in a lawsuit resulting from a dispute from the supplier, and it was after the year that a judgment was rendered against Eastern in the amount of $107. Since it's after the year, there is no entry required on the books, but a disclosure note is required. Okay, on Case B, we know that the event took place in November 2008, and the event was that the state of Nevada filed a suit against Eastern, seeking civil penalties and injunctive relief for violations of environmental laws dealing with hazardous waste. In this case, we know that on January 12th, they do reach a settlement for $140 million, and we would record a loss from litigation of $140 million on the income statement of Eastern for the end-of-year financials. And we would also record the obligation, the liability, by crediting liability of litigation for $140 million. A disclosure note is also required. Okay, in the case of C, Eastern is the plaintiff in a $200 million lawsuit, and they think it's probable that Eastern will prevail and be awarded $100 million. Well, that has nothing to do with the loss contingency, so there's no entry required, but a disclosure note is required in this circumstance. For item D, at March 31, 2010, the EPA is in the process of investigating soil contamination, and the EPA hasn't yet proposed a penalty assessment, even though management thinks an assessment is reasonably possible and an unfavorable settlement of up to $33 million is reasonably possible. But given the timing and the facts and circumstances of this particular situation, there is no entry required on the books during the year, and a disclosure note is also not required.